Matthew Bell with AlzheimersProof.com. Today I want to continue the conversation that I've been having about money considerations as they relate to long-term care planning, and in specific I want to talk about long-term care policies. In another video I'm going to get into the kinds of vocabulary that you're going to have to familiarize yourself with at least a little bit in order to make proper comparisons between policies and just thinking through the long-term care policy process. Those are going to be things like elimination period, maximum daily benefit, reimbursement policy, and many other things besides. But there is a large enough and an important enough distinction that I felt that a separate video should be made about it. And that is the distinction between a qualified long-term care policy and a non-qualified long-term care policy. So qualified in this context simply means that there is a special arrangement with Uncle Sam. And in particular, we're talking about the Internal Revenue Service, the IRS. So it's got to do with certain tax breaks that attend to qualified policies and not non-qualified policies. And if you're familiar with the language of individual retirement accounts, for example, traditional IRAs, they're often referred to as qualified retirement vehicles, and for a similar reason. They have a tax-favored status, and essentially the usage is exactly the same in this context. So in the first place, we're talking about federal-level tax breaks. There may also be breaks with respect to the state that you live in, but you're going to have to consult with licensed tax preparers in order to get the skinny on that. And in fact, this video is simply for general, informational, or entertainment purposes, and I cannot give you specific tax advice, so please don't construe anything that I'm saying as specific advice. If you need evaluations and recommendations in your situation, consult a licensed professional. There's really two types of benefit that a qualified long-term care policy might deliver. The first one is going to be generally the payments received from such a policy. The proceeds from the long-term care insurance policy are going to be tax-free. Now I say generally because there is a difference between a policy that's going to pay out per diem as an indemnity, in other words it gives you a dollar amount regardless of the cost of your care, and a policy that is paid to reimburse you for expenses you actually incur. If it's paid to reimburse you, generally it's 100% tax-free, but if it's paid as a per diem, then usually there are limits on the amount that can be excluded. Consult your CPA or tax preparer. The second potential benefit you get from a qualified long-term care policy is the ability in principle to have the premiums be tax deductible. Now to say that something is tax deductible means that that amount is excludable from your gross income when your tax liability is calculated. So if you report $50,000 of income and you have $6,000 of deductible medical expenses, then it's as if you had $44,000 of income once you have your adjusted gross income calculated. So in general, this excludability of a long-term care premium, at least in principle, means that in some cases it can be subtracted from your gross income in order to come up with an adjusted gross income amount, excluding any other deductions you might qualify for and any other niceties that are concerning your particular situation. But because of these potential tax breaks, there are a number of requirements that you should be aware of, and I'm going to divide them up into three different sections. The first is going to be medical requirements, the second financial requirements, and the third requirements that have to do with the policy itself. So that don't have to do with you, but have to do with the actual policy itself. So there are well-defined triggering parameters that have to do with your medical condition. And the first and primary of these for a long-term care policy to be qualified is that in order to get benefits, you have to lack 2 out of 6 activities of daily living, or ADLs. Now these are usually enumerated as things like bathing yourself, dressing yourself, feeding yourself, toileting by yourself, transferring, for example, in and out of bed by yourself, and maintaining bodily continence. That is, controlling bladder and bowel function. Now I have an entire video where I deal just with the ADLs, so I'm not going to get further into them here, but you have to lack 2 out of 6 if the policy is going to be qualified long-term care policy. To get benefits paid to you, you have to lack 2 out of 6, or you have to have a cognitive impairment that is significant enough to require your substantial supervision. Now the channel focus obviously is Alzheimer's, and so from the standpoint of Alzheimer's dementia, if a person is afflicted with some type of cognitive impairment, independent of any other physical maladies that they may have, they could qualify for benefits provided that their Alzheimer's or other dementia advances to a significant enough stage where they start to require constant, essentially, supervision. Whether or not you lack 2 out of 6 activities of daily living or have a significant enough cognitive impairment is not simply left up to self-reporting. It's not left up to the viewpoint of the spouse. It actually has to be assessed by a competent medical authority. So what we're talking about here is a physician certifying you as chronically ill, somebody who is a licensed healthcare professional who has got competence in these matters. Now, to be certified chronically ill involves essentially the expectation that whatever you're afflicted with is going to last no fewer than 90 days. Of course, in the case of Alzheimer's disease, once you cross that threshold from, say, early stage into middle stage, and certainly from middle stage into late stage, we know there's no coming back from those diagnoses, but chronically ill from a strict legal standpoint has to do with this 90-day threshold. So that's on a medical standpoint, but there are also financial qualifications that have to be met. The first is that the cumulative medical deductions that you have to exceed a certain percent of your adjusted gross income, or AGI. Now, up until this year, the percentage, I think, has been 7.5%. But coming very soon, I believe that the percentage is going to go up to 10%. In any case, you should know that it is subject to change at any time by the Internal Revenue Service and by any applicable and governing legislation. But this means that if your AGI is, let's say, $50,000, that your medical expenses deductible have to be at least $5,000 in order to hit that 10% threshold. You should also be aware that the deductible amount is on a rising scale. So if you are 40 years old or younger, that number is around $400. And as you age, the number increases until you get into your 70s, where it's the full amount, which is about $5,000. So you can't just deduct any amount. It's going to depend on your age, and whether or not you're going to get any tax advantage is going to depend on your overall financial picture. Now, the second requirement, besides having that percentage correct, is going to be that you itemize your medical expenses. Not everybody does, and if you don't, then you can't even hope to qualify for it. But if you do, you might qualify for it. Consult your tax preparer. Now, when it comes to receiving benefits, you will also have to worry about a Form 1099 LTC. Now, this form is going to be provided to you by the insurer, by whatever company it is paying you benefits out. And for the most part, as we stated, benefits that are paid to a qualified policy are going to be deductible, particularly if they are from a reimbursement policy. If it is an indemnity policy, which is a little bit less common, then there's going to be a limit to the excludability of those payments. I should state that you're able to buy a tax-qualified policy even if you don't meet the Internal Revenue Service's requirements for deductibility of the premiums. And one of the reasons you might choose to do that is because you're working with an insurer and they only offer tax-qualified policies, and another might be because you prefer the way those policies are constructed. So those policies have to be constructed in a particular way, and so the third set of requirements, beside medical and beside the financial that we just reviewed, are going to be policy requirements themselves. And the first one of these is that the salesperson has to provide you with a shopper's guide to long-term care policies at some point in the sales process. This guide is published by the National Association of Insurance Commissioners. It's about 70-something pages. It's also available online. You can just Google it. I'll put a link in the description. It's a very helpful guide, and it's published by an organization that has no stake in your purchasing from any particular company or buying any particular plan. So I recommend that you get it and take a look at it. The second policy-specific requirement is that the policy has to be guaranteed renewable. Now, to understand guaranteed renewability, I'll just briefly run through the possible classes. Long-term care policies are generally classed as health insurance products, broadly construed, and so the people who sell them have to be licensed in healthcare products and health insurance. And in health insurance, there are a number of different classifications for policies. So, for example, on the very lowest level of policy might be non-renewable. So, for instance, a policy you purchase just for a vacation or a trip is essentially going to be non-renewable. You couldn't renew it under any circumstances. A notch up from that are policies that might be renewable, but the insurance company can cancel them at any time for any reason, and they're called cancelable policies. A notch up from that is optionally renewable. It could be renewed on the option of the insurance company or not. Conditionally renewable is a little bit more favorable for the consumer. But the notch up from that is guaranteed renewable. And what that essentially guarantees to the consumer is that the consumer cannot be excluded from renewals on the basis of insurability. In other words, once you have the policy, you no longer have to demonstrate proof of insurability in order to renew it year after year after year. So that's a very important consideration when it comes to long-term care, because obviously you don't want your long-term care policy to be dependent on you not needing it. Once you qualify for it, presuming you do, then you are guaranteed to get it so long as you continue to pay the premiums. the company cannot cancel you. Now that said, the premiums are not guaranteed. There is a notch up from guaranteed renewable called non-cancelable, where even the premiums are guaranteed never to increase. So for guaranteed renewable policies, the premiums could increase. There's no guarantee that the premiums won't increase, but the guarantee is that they cannot increase just for you individually. The insurance company can't take a look and say, John Doe or Jane Doe is a particular risk, we're going to raise his or her insurance premium. They can only raise classes of premium. So if you fall into a class, maybe residents of California or all people over the age of 75, they can raise the premiums for a class, but not just for you individually. Now that's required in order for the policy to be a qualified policy. It has to be at least guaranteed renewable. Now you might find policies that are non-cancelable, but generally speaking, they're not going to be very popular policies even if they are available, and that's because those policies would be very, very expensive. So they would be cost prohibitive for most people, and frankly, for most people, that guaranteed renewable option is going to be the one that gives you the best of both worlds in terms of the guarantee that you can't be canceled, but also has a premium that, although it might increase, is still going to be affordable at the time that the person applies for the policy. Now, a couple other things the IRS requires of a qualified policy. Number 3, that the policy cannot have cash value. That just complicates things. If you could cash the policy out, it's going to complicate things, so a qualified policy will have no cash value. And number 4, it can't reimburse you for things that would be covered under Medicare, generally speaking. Now, as an aside, the laws that govern this are going to be the Internal Revenue Services Code, the IRS Code, and also the Health Insurance Portability and Accountability Act, or HIPAA, which was made into law in 1996. So non-qualified policies are essentially going to be negations of a lot of what we just discussed. So first and foremost, premiums for a non-qualified policy cannot be deductible for any reason, regardless of how much of a percentage they are to your adjusted gross income. You just can't deduct them. So number 2, whereas for the qualified policy you had to itemize medical expenses, here it makes absolutely no difference. You could itemize if it benefits you otherwise, but itemizing for a non-qualified policy makes no difference to its deductibility. Additionally, it can have benefit triggers different from the qualified policy. So we talked about the medical triggers being the 2 activities of daily living and the cognitive impairment requiring substantial supervision. But in this case, an insurance company is essentially free to use those if they wish, but they could use something else. And in many cases, there's something called medical necessity, which is just a doctor thinks you need some care, and that might be sufficient to trigger benefits on a non-qualified policy. So in a way, it's a little bit less rigorous, but it's also a little bit less well-defined. You do not need to be certified chronically ill. So in other words, there's no 90-day requirement for a non-qualified policy, at least insofar as the federal government is concerned. The insurance company itself may have requirements that include certification by a physician, but that's up to the insurance company. Once they've opted out of trying to shoot for tax deductibility, it's essentially up to them. Obviously, they have to conduct themselves in a fair way, in a predictable way, but they're free to use those requirements or not. Because this is less scrutinized, some online sources will refer to non-qualified policies as more liberal in their benefit triggers. I suppose from one standpoint that's correct. They can use medical necessity and some other triggers that are not as well defined and as rigorous as the ones that are required for a qualified long-term care policy. But on the other hand, you might think that some of these things are a little bit less well-defined, and whether that's good or not is going to be up to the opinion of the consumer. Now, the NAIC Shopper's Guide that I held up previously states that benefits from such a policy, a non-qualified policy, generally are counted as income. There are a couple of exceptions to that. One exception might be if you had a policy that was in place prior to HIPAA being passed in 1996, then it's likely that that policy might be grandfathered. You'd have to consult your tax preparer. Additionally, the Form 1099 LTC, the form that you're given when an insurance company pays you proceeds, basically makes reference to certification as chronically ill. So I suppose it's open that a long-term care policy that's non-qualified could still require you to be certified chronically ill. And if that's the case, and your benefits are predicated on that certification, then those benefits may also be tax deductible. But there's no guarantee of this, and you'd have to consult your tax preparer. Now, I know this is a lot of information. Some of these things are going to have to be revisited, I think, once you start to actually consider individual policies. In a separate video, I'm going to help walk you through some of the ins and outs. besides this tax qualified idea, because the policies are complicated even after you get over the tax qualification idea. But I hope this was enough to start you off. Let me kind of briefly summarize some of the differences between the two policies. So on the plus side, a tax qualified policy makes it possible for some people to have certain tax advantages. That is true. But a negative is that those tax requirements are sometimes difficult to meet. Number two, on the positive side, tax qualified policies have clearly defined triggers. But on the negative side, you might think, well, those triggers are well defined, but they're also more rigid, and so they're harder to meet. And number three, on the positive side, a qualified policy has more consumer protections, but again, as a negative, those protections might increase the cost of the policy. So insurers who are shooting for a tax qualified status on their policy are required to have certain things built in, but they're not required to give those protections for free. So sometimes those do increase the cost of a policy. In other words, a guaranteed renewable policy is going to be more expensive than a conditionally renewable policy. And so you, the end consumer, are going to have those costs translated to your premium bill. Now, in the case of a non-qualified policy, on the positive standpoint, there are no tax rules really to have to follow. But on the negative standpoint, there are no tax breaks either. From the positive standpoint, a non-qualified policy could be considered more fluid in terms of its triggering rules. It's often referred to as more liberal in that regard. But on the negative side, as I've said, you could think, well, it's a negative because it's less well defined and therefore a little more vague. And finally, non-qualified policies may have ancillary benefits that are not possible under a qualified long-term care policy, for example, where things might overlap with Medicare. But on the negative side, they may also not have non-forfeiture and other consumer protections that long-term care policies that are qualified are required to have. So I hope this video gave you at least a start in trying to understand the difference between qualified and non-qualified policies. Please stick with me as I get into the series. If these issues are of interest to you, please click like if you found it helpful, subscribe to the channel, click the notification bell to be alerted to new content as it becomes available. Feel free to drop me a comment if there's something else you would like me to discuss. I look forward to seeing you again in another video, and I thank you so much for being with me today.